Welcome to the video. Today we're tackling a high-stakes question many savers face. Should you invest a large cash sum all at once, or drip-feed it into the market over time? Especially with volatile headlines and AI-fueled speculation, we'll focus on long-term growth, the UK ISA allowance, and a practical plan you can use today. First, we'll outline the agenda. Then, we'll clear a quick disclaimer. Next, we'll compare lump sum investing and dollar cost averaging, examine what historical data says, and build a step-by-step strategy that balances psychology and performance. Finally, we'll wrap up with key takeaways and a short quiz to test your understanding. Let's begin. Here's our roadmap. First, we define the dilemma between investing everything now versus spreading it out. Next, we look at what historical data suggests about performance. Then, we apply this to the UK ISA context and outline a practical, step-by-step plan. After that, we address risk management and common behavioral pitfalls. We'll include a couple of quick quizzes to reinforce learning. Finally, we close with key takeaways and a summary. Let's proceed with an important disclaimer. Before we continue, a quick disclaimer. This video is for education only and is not financial advice. Always do your own research and consider speaking with a qualified professional. Tax rules such as ISA limits can change, and investments can go down as well as up, so your capital is at risk. With that in place, let's move on to the core dilemma. Here's the central decision. You have a large sum ready to invest. Do you invest it immediately as a lump sum, hoping to start compounding right away? Or do you spread your purchases over time using dollar cost averaging to reduce the emotional stress of volatility? Many investors lean toward DCA when crash fears intensify. However, historical evidence provides a controversial counterpoint. Let's explore the data next. Let's interpret the historical evidence. Over many long-term periods and across different markets, lump sum investing tends to outperform approximately 2/3 of the time. Main reason is compounding. The more time your money spends in the market, the more time it has to compound. By contrast, dollar cost averaging can reduce volatility and regret, but it leaves a portion of your cash uninvested for longer. This drag can lower expected returns versus investing immediately. Additionally, trying to perfectly time market crashes is unreliable. Therefore, data suggests that for long horizons, time in the market generally beats market timing. Next, we'll compare LSI and DCA more directly. Let's compare directly. With lump sum investing, you put the entire amount to work immediately, maximizing time in the market and, historically, improving expected outcomes. The trade-off is shorter-term volatility and an emotionally tougher experience if markets fall soon after investing. With dollar cost averaging, you spread your entries over time. This reduces regret and makes the ride feel smoother, but it often lowers expected returns because significant cash remains on the sidelines. Now, to solidify this, let's map the trade-offs in a concise matrix. This table summarizes the trade-offs. Expected long-run returns tend to be higher with lump sum investing, and it outperforms in roughly 2/3 of observed periods. However, the short-term pain can be higher if the market falls right after you invest, which can be emotionally challenging. Dollar cost averaging provides more psychological comfort and smoother entry, but usually introduces cash drag and complexity. With this perspective, let's design a decision process tailored to UK ISA investors. This flowchart starts by asking whether you have cash ready. If not, it points you to continue building savings and set a direct debit. If yes, it asks whether you use an ISA. If you do, it recommends depositing the full amount into the ISA cash account immediately to secure the tax-free allowance. If you do not yet have an ISA, it guides you to open one and then deposit. From there, the decision hinges on your comfort with volatility. If you are comfortable, invest the lump sum into a diversified global index fund right away. If you are not, set a short, predefined DCA schedule, such as 6 to 12 weeks, drawing from the ISA cash balance. Both paths then converge on automating contributions and rebalancing annually, while maintaining an emergency fund and avoiding concentrated bets in speculative areas. Next, we'll turn this into an actionable step-by-step plan. Here is the practical plan. First, open or sign in to your Stocks and Shares ISA. Next, deposit the full lump sum into the ISA's cash holding. This secures the tax-free allowance for the year. Then, choose diversified, low-cost global index funds. If you are comfortable with market swings, Invest the entire amount now. If you prefer caution, create a short dollar-cost averaging schedule, such as weekly purchases over 6 to 12 weeks, funded from the ISA cash balance. After that, automate your ongoing contributions and set calendar reminders for accountability. Rebalance annually, keep costs low, and maintain a separate emergency fund so you are not forced to sell during market stress. Finally, avoid over-concentration in popular or speculative sectors. Now let's add risk management guardrails. To manage risk, diversify broadly using global equity as the core, and add bonds according to your risk tolerance and time horizon. Keep costs low because fees compound against you. Align your risk with your time horizon. Longer horizons can typically support higher equity allocations. Maintain an emergency fund so you do not have to sell investments during downturns. Automate contributions and rebalancing to limit emotion-driven decisions. Lastly, avoid concentration risks, even in exciting themes such as artificial intelligence. Now let's address crash fears directly and the psychology behind them. Crashes feel frightening, and that is normal. However, decisions rooted in fear can be costly. It is better to rely on a pre-committed plan than on short-term predictions. With that in mind, let's briefly explore the behavioral traps that trip up even seasoned investors and how to counter them. Common behavioral traps include loss aversion, where losses feel more painful than equivalent gains feel rewarding; recency bias, where recent events overly influence expectations; fear of missing out, which encourages chasing hot sectors and raises concentration risk; and paralysis by analysis, where the desire for a perfect entry point leads to inaction. The antidote is to pre-commit to a written plan and automate execution to reduce the influence of emotion. To visualize how entry schedules differ in time, let's look at a simple timeline. This timeline shows two paths over roughly 3 months. The lump sum path invests 100% on day 0 and remains fully invested thereafter. The short dollar-cost averaging path allocates roughly 8 to 9% each week until fully invested by week 12. In a rising market, lump sum benefits from being invested earlier. In a falling then recovering market, the DCA path may feel better emotionally because you buy more during the dip, but if the recovery is swift, the lump sum can still come out ahead due to longer time invested. Now, let's test your understanding with a quick quiz. Question 1. Over long horizons, which approach has historically outperformed more often? Option A, lump sum investing. Option B, dollar cost averaging. Option C, they always tie. Option D, market timing beats both. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A, lump sum investing. Historically, LSI outperforms in approximately 2/3 of observed periods because it maximizes time in the market and therefore benefits more from compounding. Question 2. If you are nervous about volatility but want to secure your annual ISA allowance now, what is a practical approach? Option A. Keep cash in a current account and wait for the perfect dip. Option B. Deposit into the ISA cash account now, then dollar cost average into diversified funds over several weeks. Option C. Put everything into a single hot AI stock immediately. Option D. Avoid investing for a year. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. By depositing into the ISA cash account now, you secure the tax-free allowance immediately. Then, phasing investments into diversified funds over a short schedule helps manage emotions while keeping you on track. Here are the key actions. First, secure your ISA allowance by depositing your lump sum into the ISA cash account as soon as you can. Second, remember that for long horizons, lump sum investing tends to win. But if you are uneasy, a short, predefined DCA from ISA cash can help. Third, invest in diversified, low-cost global funds and avoid concentration risk. Fourth, automate contributions and rebalancing while maintaining an emergency fund. Finally, prioritize time in the market over trying to time the market. In summary, choosing between lump sum investing and dollar cost averaging is a trade-off between expected returns and psychological comfort. Historically, lump sum investing outperforms most of the time, primarily due to more time in the market. In the UK context, securing your ISA allowance early is powerful. Deposit first, and then deploy. If you are nervous, use ISA cash to run a short, rules-based, dollar-cost averaging plan into diversified funds. Finally, automate, rebalance, manage costs, and keep an emergency fund. As we close, here's a quick thank you and a request. Thank you for watching. If you found this valuable, please like the video, share it with someone who might benefit, and subscribe for more evidence-based investing guides. Tell us in the comments which approach you prefer, lump sum, dollar-cost averaging, or a hybrid, and why. Your insights help the community learn. See you in the next one.